I'm doing what I do because, and have seen a fair amount of success because of things that I've learned and my ability to make decisions. And sometimes it's the wrong decision immediately. Maybe it is, but I would rather make the wrong decision fast than the right decision in a slow, methodical, years-long process.
Welcome back to the show, people. We got with us James Clarke. James, good to be here.
Oh boy. So glad to be here with you, Bridger.
So people that don't know, I met James, I think 2018 we just said. I was the TA at Brigham Young University for the Entrepreneurship Lecture Series, and James was this big wig, still is a big wig, Utah name, and came in and you actually taught, I think 2 or 3 times I was there, where you came and did an Entrepreneurship Lecture Series where you just donate some of your time to come and just teach students and mentor students, which is amazing.
Best thing we do.
Yeah, it's pretty fun. And just so you guys don't know, and I'm going to have you kind of talk about yourself like the whole time, but James, incredible career with Clearlink, your family office, investing for years and years and years, but also huge into philanthropy. I've seen a lot of your efforts, and I know probably half of them you don't talk about. The half that you do talk about are impressive. You know, you've got the Clarke building and UVU, a bunch of other big stuff, Hale Center Theater. I've seen all sorts of it's funny, you come to Utah and you see Clarke all over the place.
I'm so sorry.
So anyways,
I apologize for that.
It's pretty cool.
No, that's kind of it. I really appreciate it, Bridger.
Well, welcome on. Yeah, welcome on.
Honored, really, truly. So it's been fun to watch from afar. I've said this to you before, and I'm going to say it again. Bridger Pennington here, James Clarke here. It's fun to see what's happened over the last 5 years. Yeah, so I'm really proud of you.
So walk us through this. So you were at Clearlink, which is your original company you founded way back when. Yeah. And I want to hear that story a little bit, but then you exited that. You had a great exit.
That's great.
Now recently you're back at your original founding company. So, and how many years later? 20 years later?
Yeah, it was started in 2001, just weeks after 9/11. Nobody believed in the internet anymore. The dot-com bubble had burst. Capital markets were completely dry, so we had no place to even raise funds if we needed them, and we did. Yeah. And so it was an interesting ride those first few years to really get to cash flow positivity, and that was the goal. My wife was the number one seller of a certain drug at a drug company. She was a drug rep, and she had a great income, and we wanted to start a family. We got married late by Utah standards, and we wanted to start a family. And so my promise to her was we would start cash flowing by a certain date so that we could start our family. And fortunately we did. So that was very early on. But again, as we started that business, first firm that we engaged to do our sort of tech stack, they took, the deposit that we gave them, went out of business. Same thing happened with the second one. Third one, we found alignment. I know, right?
How big were these deposits?
Imagine the day, though. I mean, it's hard to imagine this many years later that people just stopped believing that the internet would be a thing. We're sort of seeing that again in crypto. This crypto winter that's taking place right now. It is a thing. It's not going away, but it's a reset moment for us all. And so it's interesting to see how history repeats itself in one form or another. But truly, that was it was a great blessing to us because it cleared out the competitive landscape, allowed us to then really grow the business. But from day one, post-launch of the technology, we were cash flow positive, and away we went.
And walk us through real quick, what's technology? What were you guys selling at the time? I'm sure it's transformed now. At the time, what were you doing?
It's a generous question, but I'll back up just a little bit. So I started selling pest control door to door the summer of '94.
Oh, were you really?
For a friend named Todd Peterson, whom you now know. And it wasn't the company that he started then, which I worked for, called CMC, that went out of business the summer that I worked for him. And so I didn't get my full paycheck. And as a favor, and I love Todd.
Have you teased him about that?
Listen, I'll love that man to the day I die, because as a makeup for that, even though he took his licks in the process, he let me have office space to start my own company that was competitive to what they were doing it then. They called it Apex when they were selling door to door. And so we were recruiting our own door-to-door people to sell satellite dishes door-to-door. Dish Network, DirecTV, great booming market.
This is 1994.
So later on, this was sort of late 90s, 98. So years later, he did this for me. And it was one of the great, everybody's got a moment in their career or their life where someone gave them a leg up or a second chance or believed in them. And that was that moment for me. And Todd really has been one of those great mentors and friends to me for the last, sort of 25, almost now 30 years.
People that don't know Todd, founder of Vivint, which is now IPO'd, big, huge, multi-billion-dollar company, and they've just killed it.
Just one of the great entrepreneurs you'll ever meet. The Vivint Arena here, where the Jazz play, just as good a human being as there is. So everybody needs sort of that kind of break, and he gave me a break, and I'll forever be grateful. So was doing that, selling door to door. Thought, okay, there are all these services to the home that people are selling door to door. Why couldn't we take this on the internet? But by that time, it was, you'd heard of all the internet startups and, the boom and the bust. And I stuck with it, and I just said, I'm going to do this. So I left that partnership, decided that I would take all these things like pest control or, cable and internet and those kinds of things that were being sold door to door and sell them online. And that's what Clearlink started at. And what we do today, we're, in a sentence, we're an online retailer of services to the home. So today the company has about 1,000 full-time employees. I think it, has ebbed and flowed to where it had as much as, or as many as 3,000 employees. We've sort of, I think it's the right size for what we're doing. We're on 5 continents. We drive billions of dollars of revenue for our brand partners. We book a certain portion of that. It's a profitable business. It's sold, when I sold it in 2011, was to Pamlico Capital. They used to be Wachovia Capital. Then it sold 5 years later.
So walk me through that 2011 sale, okay? So
okay, well, sorry, I get ahead of myself.
No, you're good. This is great. So 2011 sale. I've had a few offers for my company and stuff. It's an interesting thing. Were you approached with an offer? Did you guys go to market? Were you raising rounds of VC? What was kind of the thing?
So because of my good wife and our ability to bootstrap, and the gift that was very hard at the time, was that we couldn't raise capital. There was no money to be found to raise into an internet startup at that time.
Which is such a good lesson for people right now. Like, it's too hard to start a business, whatever. You're living proof that it's actually, you can do it in any market, anytime. And actually sometimes it even benefits you. Sometimes recessions get you more talent, less competition. It's a lot sometimes easier in other ways.
Such a good point, Bridger. And we saw that because it just completely cleared out the competitive landscape. So we had sort of one other major competitor when we came into the market, and our thesis was, if we're just this much better at sort of marketing, if we're this much better at sort of how we do what we're doing, I think we can be, a larger company than that. And that was a great benchmark for us, because they were doing $20 million of revenue at the time, which I thought was enormous, and it still is a good sized company. But for us, we surpassed that company very, very in short order, and it was a great thing for us. So again, we love down markets because there's so much opportunity, but you do have to use that mindset switch to think about how you're going to take on these challenging economies.
So 2011, were you approached with an offer? Did you go shop with a broker? What'd you do?
The reality is we thought we were going to sell in 2008. I'd really walked away from the business in the sense that I was interested in doing some other things. I had brought in a CEO that came through an acquisition and sort of turned the keys over to him, knowing that I didn't want the golden handcuffs that come so often with a transaction. So we shopped. We had offers. 2008 hits, and of course everything goes away. And so we had sort of 2 years to sort of figure out what we were going to do.
Did you just dive back into the business, or was your CEO still running good?
That's where it sort of takes us to our next chapter, because at that point, I'm out of a job. I've still got ownership in this company, and I'm trying to figure out what my next step will be. Once we have this liquidity event, what will I do? So in 2008, while everybody's running from Wall Street, I set up an office there to kind of figure out what I'll do. Is it venture? Is it sort of private equity? I knew I wouldn't have sort of the billions of dollars to do private equity, true private equity as it should. But growth equity was really interesting for me. Seeing that you could sort of take a cash flowing business and take it from here to there with some I think I was going to say operational, and some operational expertise. Sorry, I just mixed those two words together, didn't I?
It sounded good though. It came.
Please don't let that one show up. But it's to take a little bit of operational expertise in what we were doing and then help grow those businesses. And that's really what we've done as a family office. So it really set me up. So
you started your family office even before your exit.
Well, I was learning.
You were already doing it.
And I'd been investing, and you know how this is. And I'm sure you get pitch deals all the time too. It's like you're a successful entrepreneur and people are coming to you and pitching you ideas and thoughts, and you're in the fund business anyway. But for us, I'd been allocating to those kinds of things for years, and we saw some great success. And I didn't realize that some of the success was just luck. And I didn't know if I was lucky or good, and I wanted to find out. And so that's what those 2 years were on Wall Street. And then immediately after we sold, the first Monday of January 2011, because we wanted to carry it into that year.
Yeah, get the taxes.
You know what my thoughts are. We set up our office.
And just people that understand that, like you don't want to sell a company in December, because now you have 30 days to do all your tax planning for the year. It's pretty hard. So a lot of people will sell, hopefully Q1, where you gives you 9-8 months to then buy real estate, depreciate assets, buy oil, whatever you're going to do to.
Well said.
Just so people are aware.
Well said. It didn't make the bankers very happy because it didn't meet their year-end bonuses. But
then also, usually the buy side wants to sell by the end of the year because there's a whole tax thing.
So we remain friends still. But it was a good thing, and immediately we started allocating. Our first deal we allocated to is a company called Contour. It's a camera company that most people wouldn't know of. But it was the competitor to GoPro. At the time when we invested, they were larger than GoPro. And then
So I've heard this story actually. I remember the story. It stuck with me.
Isn't it wild?
Because of it seemed seemed like an obvious play. And I walk us through the story of investing into this competitor of GoPro. This is before GoPro was even a thing.
It's a category creator story. Of course, you saw that with GoPro, and of course they emerged as the leader, but it wasn't because their technology was better. Ours was far better by almost every account. It wasn't because it had a better form factor. There's looked a little like it, and still does to some degree, a Teletubby on your head versus the sleek, cylindrical, very 21st century version of a camera. It looked like a bullet, and by all accounts, it was the smart play. It was the right investment.
So you have two companies. One's a big blocky box that's kind of slow. The other one's a sleek, cool camera that looks awesome, could attach to your helmet or whatever.
Precisely.
Who would you invest into? Well, probably the sleek, new, cool one.
That's it.
And then what?
So we were working with a young entrepreneur. He was just out of University of Washington. They're based in Seattle. This deal was brought to us by Black Oak here in town. We really liked the deal. We allocated. I joined the board, and I remember because I had these relationships from the second deal that I'll talk about in a moment with Walmart, some very large retailers. We've really focused on consumer throughout the years, but these were our early days. And I said to the CEO, we've got some great relationships with Walmart. How would you feel if we made an introduction there? I think they really like this in consumer electronics. It's a place where they're really betting right now, especially as it pertains to these action cameras, this new category that people are just learning about. He said, I don't want to sell out. Famous sort of last words. And that was the beginning of the end, because immediately GoPro got into Walmart, and they went from about our size to sort of $250 million, $500 million of revenue, and almost $1 billion. That's when they IPO'd and went straight to sort of $12 billion of market cap. Wow. It hasn't been as rosy for them after that, but it's just a great example of technology not being the winner. I mean, it's execution. Everything's about execution. It was a great lesson to me, but also helping people understand, listen, that is not selling out. That is selling up, and that is building enterprise value within a business. And so I learned a lot there, and it was really interesting.
One pivotal decision.
It was
from an entrepreneur changed the whole course of that. That's so interesting.
And it ended up not being a bad thing for us in the end. I allocated another large sum to that business, and then they called me back 2 weeks later and said, if you don't allocate another sort of 7-figure allocation into this one, they're going out of business. I said, we're going to just have to let them run off a cliff. They did. We bought the company and the asset back out of the receiver's sale from the trustee and pivoted it towards the IP play. We took the technology, which we had built out, that even GoPro, we would argue, was using at the time, and many others, and turned it into this intellectual property play. Ended up being one of the larger IP, transactions, in recent history. And so it was a good deal for us.
And who'd you sell? Can you say who you sold to?
They're not by name, but private equity, a couple billionaires out of Texas. A former senior executive in a consumer electronics company took it on, and they've leveraged that in a very meaningful way. So, and you use the technology. I promise right now we're using some of that technology relative to online streaming and wireless connectivity between a device and a camera. So
okay, I want to unpack that for a second. Talk about, a lot of people on the show, we talk about funds and investing, and everyone talks about their best deal, and then I love hearing about their worst deal. I usually ask that question.
Well, that certainly was our worst deal.
But then you turned it into something very profitable. So walk up, maybe somebody through that maybe has a deal that goes sour or south. What does that look like? Some people just say, I'm just never going to talk about this again. You guys went through a whole asset sale. You purchased. What kind of happened there?
So unpack that for us. I'll say it this way. When I went back to school and I was doing my dissertation, I was overseas doing this degree. My dissertation was about sort of innovation and strategy in major programs, mega projects over $1 billion in scale. And we talked about certainly pivot again. But I asked the question, everybody I interviewed 17 CEOs or senior leaders within very large businesses. Of these 17, they managed or had built about $500 billion worth of enterprise value. So it was a great sample. But I remember asking a question, and the question was to a Hall of Fame quarterback. You'll probably, through deductive reasoning, figure out who this was. Asked him, I said, as I asked all of them, I said, so do you love to win or hate to lose? And he said, I love to win. He'd won Super Bowls and all kinds of things, and great hero of mine growing up. About 20 minutes into the rest of the interview, he stopped. He said, okay, James, I just got to go back to that question. The reality is I hate to lose. And I learned that about myself that day. I learned that a lot about, I really drilled down as part of my research when I was studying, what does it mean to hate to lose? And why is there a power in that? Because I found that there was sort of this, of the sample, the vast majority felt that same way. It wasn't just good enough to win. To hate to lose was really powerful. And so it's a softer side of what we talk about in management and business, but it's really powerful. This notion of, I hate to lose. Therefore, I win. And
you'll scrap. You're gonna do whatever it takes. And when you do have a taste of a loss, we'll go into the crap and figure it out and turn it into something which you did.
Exactly. And that's really what we've done as a business. And we really hate to lose. And we don't lose very often. When we do, we try to pivot again and find, the win on the other end of that. And so I think, especially even as we structure our deals, and you can do this in growth equity, and you should do this in every deal, is look at it from a standpoint of trying to de-risk it naturally. You want to do that, but also if you're not in just general venture where you're placing bets, closing your eyes and writing a check and here you go. If you're really trying to de-risk those deals, you're looking at it from a standpoint of my downside should actually be upside. Meaning that if the stuff hits the fan, as it always does, and I have to sell this business tomorrow, is there enough upside in it? So did I buy it right? So you win as you buy right, but also then you can be additive and you can add the sophistication. You can add those things that most investors expect that they will give, and most entrepreneurs expect from those investors as well. So that's an important part of how we've looked at every deal, is how to de-risk and make sure that our downside is also our upside.
Yeah, interesting. Can you give a few examples of that?
Yeah. So
de-risk. I love that. De-risk on the buy. You got to buy at a good price, but think walk someone through if they're doing that in private equity right now. What would be an example of that?
We had a really interesting deal come to us right in the heart of COVID. So this was sort of I think the big day in COVID was March 17th or thereabouts of 2020. A month-ish later, we saw a deal that came out of the SoftBank portfolio of companies. They were quietly, a la WeWork, and the challenges that they were seeing, they decided to shut down a number of their businesses, which is just fine in their venture, and so they can do that. They they and other investors had put almost $300 million into a business. That business came up for auction. It was an opportunity, and someone who was working with a trustee came to us and said, hey, would you like to sponsor this? Go 50-50 on it. We thought that's a great idea. It's interesting, but we had to look at it. We looked at that deal initially and closed on it 10 days later. I mean, we wrote the check 10 days later. So how do you underwrite that? Well, you can't. You just have to know that you're buying it right. The price was right. We were buying that business, or
based on assets. Just based on the assets.
Okay. And so this came down to both social media followers, IP, real hard physical inventory that they had on the balance sheet. They had between, depending upon how you looked at it, between $10 and $15 million worth of inventory. We bought that business for substantially less than the value of the inventory. Naturally, that was not all in durable goods, so we had to write off some of that. But in the end, if we had to sell that business the next day just for inventory, or write that down in some way, or flip it to a discount broker, as we did with some of the assets, there is enough of an asset that our downside scenario was our upside.
You're not losing money. You're going to gain money in the worst case scenario.
Right. And so and then you've actually got to operate a business. Then you've got to hit the reset button and say, okay, there's no team. There's nothing here other than these assets. We recruited a team, a world-class CEO in Sydney Tetro, raised a first round. And this was, I think, the largest first round of any female-led business in the state of Utah at $118 million, both debt and equity, which is really meaningful.
Sydney's amazing too. She's an amazing founder.
Unreal. If you haven't had her here,
I should have her. Yeah,
got to be on your list. But she is world-class in every way. Sold her last business to Disney, reported to the Disney board. Is just wonderful. And she and I now run this consumer summit here in the state of Utah, which is really getting some legs in our second year, which is fun. But she then, that next year, the first year, I guess, under her leadership, we went from zero to about $24 million of revenue. Our second year under her leadership, she did just under $100 million of revenue. I mean, she knows how to run businesses, but the opportunity was there. It was solid, it was sound. But again, we tried to de-risk that from day one. And that's what we do with our deals in general.
Let's come back to that story. So we talked about Clearlink earlier, 2011, you ran the family office, lots of cool deals. So what happens recently, you decide to go back to this company that you sold years and years ago. So walk us through that decision. What happened?
The glutton for punishment, right? It's it's one of those great gifts that life gives. And I'll just never say never, knowing what this opportunity has brought to us. Having sold the business and doing that early on, it made sense for us. Anytime you have 99% of your net worth tied into one singular asset, you always want to look at a way to sort of take those chips off the table. What I didn't realize that I could have done that in a number of ways. I could have done a recap. I could have even done a debt recap, not taking equity. I could have brought in a strategic partner that could have helped grow us. I could have brought in a different kind of really seasoned CEO versus those that I sort of left and entrusted the business to. But again, you learn through this process, and I wouldn't change any of it. But coming back to the business, we looked at it. Even the 5 years in, and we'd been close with a lot of the guys at SoftBank, and they reached out to us 5 years in when it was going up for process again. Private equity was going to get out. It came up for auction, and they took it out to do their process. They said, well, this is very interesting for us. We own T-Mobile. Well, at the time it was still Sprint. We own Sprint, and want to have this kind of outlet to be able to do all these services to the home.
Yeah, cool.
So they said, if you want to come in, we'll share the GP. You take half of that, and you could come in back and run it. I thought that's really interesting.
Oh, interesting.
The price got away from them because even between
what year is this?
That was in 2015, 16. It sold in 16 again. Okay. They watched the numbers. I looked at the numbers when they were in the process, and they had tripled the top line in those 5 years. And go them! It was fantastic. Yeah. But they'd only added $6 million of EBITDA.
Oh, interesting.
In 5 years. And so for that, I think they were just like, where's the real growth? Where's the the earning? And which was also disappointing to me because it was on such a great trajectory. It was far more profitable back then, and that's kind of been the story in this. So that's the gift that it gave us, is that, to their credit, and they built those that took it on after me, and started calling themselves founders, and that's okay. But it was one of those things where they, I think this is a business that should be doing billions of dollars in revenue rather than sort of where it is today. Again, it's profitable. We had a really fun, these last 12 months being back, we grew bottom line 30% year over year, which is healthy for an established 20-year-old business. However, we've got to grow that top line. We've got to become the kind of business that it was intended to become from day one. And that is a multi-billion-dollar, true to its heart and its roots, tech business that provides a lot of value, and people see it that way. And so one of the first things we did is, plant our flag right in the heart of Silicon Slopes. We were located in a few spots throughout this, the two valleys here in Utah County, in Salt Lake by the airport. And we wanted to be right in the heart of where tech is happening, right where you are, frankly. And so we've just gone to the point of the mountain. It's a great campus. Right up here then? We are. We took the other half of that Pluralsight building.
Great.
So it's a beautiful campus. It's first rate. So many of our colleagues that have worked in Silicon Valley, I've said this is by far the best space that they've even seen amongst those peers there.
Cool. Yeah.
Even certainly amongst our peers here in Utah. So it's a beautiful first-class space.
People that don't know, I call that building the Death Star whenever I drive by it.
You're not the only one.
It looks like the Death Star.
It's
You're
beautiful.
Like, and I always said, I want to be in that building one day.
Aaron Sconard and team that sort of put that together. But their business is very different. And I think, getting people back on site, while difficult and challenging, has been such a boon for our business. I can have meetings that take me 60 seconds or 5 minutes that normally I was spending, half hour or 20 minutes. I could just accelerate.
So you're big
the
in-office
pace
guy.
of my business.
Do you let employees work from home, or
they are today?
You are,
and I don't love it. But a lot are those that are at our office, and certainly my senior leadership team is there every day. But we have accelerated our pace by just being there live and in person. So yes, we will always be flexible relative to a workplace environment, because I think flexibility is here to stay. It just is. But there is something that we're missing out on by not being there in this tactile sport that we call business. And you can only do that, having this kind of dialogue. Otherwise, I would have phoned this in today. I could have done that. But it is better to get in the car, sit down, bro hug, and whatever that needs to be. There is something about building that relationship face to face. It's the ultimate contact sport of business. And I love that part of it.
Well, it's been interesting to watch Elon Musk come to Twitter. And there's been goods and bads from that. We can talk about it forever.
I admire it, but boy, it's gutsy.
It's shook up. I think a lot of CEOs have looked around and said, you know what? I can do that. They felt like maybe their hands were tied, or like I can't. And it's like, you know what? I have a lot of authority in my business. I can kind of make decisions if I want to. What are your thoughts from that whole thing with Elon?
I think a year ago I would have said it differently. I don't know that you could have in a different market where layoffs weren't as commonplace as they are today. Today, you can do that. And we want to be sensitive to our employees and our people. Lives have changed a lot, but we only did that because of an event. That event has largely subsided and is over. And we've got to get back to work. And notice that I'm not saying we got to get back to the office. There's just a lot of work that is not happening. And people, I think, especially if you have not had the experience of working in an office with someone, that part of it we're missing out on. Leadership, mentorship, friendship. That is, and that's, these
you don't get working at home.
Ships of all. Exactly. You just do not get that. And frankly, the comment that comes to me most is people are looking at their own mental health and saying, I did not believe that I was in sort of the state that I was before we started back and in person, and I am doing so much better, and I am so much happier. And so that's gratifying, but it's not easy.
Yeah.
And you're expecting a lot from folks, and we lose people. There's an attrition factor in this. And we'll expect that we'll continue to see some of that attrition. But listen, it's the right thing. And I'm going to convince people within our organizations that it's the right thing because it works for us. And that's the acceleration that comes with that is real.
I love it. I couldn't echo it more. It's funny to see this transition across a lot of CEOs that I've interviewed to that realization. Is like, yeah, we tried it in COVID. It was okay. And we are missing a huge piece that is just, and we need to win. We have stuff to go after. We hate losing. We want to win, and the way we're going to win is going to be together.
That's right.
And ultimately become happier, better people doing that. I love it. I know your time's valuable, so we'll get you out of here. I got 2 last questions for you.
Oh, okay.
Second
Are
last
these
one.
the zingers that you're ready to give me now?
Yeah, I'm ready to just zing you. No, the second last one is just if people want to follow you or be part of just see you online or any way to connect, is there a good spot you can send people or just to go learn more about you or your companies? Where's a good spot to go?
Listen, it's a very generous question. I have a terrible answer for. I'm not great at that. I use LinkedIn a lot because I like to, build these relationships. Sometimes I feel like networking seems a little crass to me because, as a term, because it really for me is just about building relationships. So I'd love to have relationships with any of your followers and listeners. LinkedIn is sort of my primary, if you will.
Okay.
And
so James Clarke on LinkedIn, Clarke with an E.
Yes.
Go look me up.
Yeah, okay. and I'd love that. I just there is. I love personal meetings like this, and I wish I could go meet millions of people this very same way. And so, whatever that looks like in the virtual world, I'll do a better job. Yeah. But grateful you'd asked such a generous question.
Okay, and then final question. I love asking my guests this. So, if you could leave this audience with one thing. So I'm gonna give you about a minute and a half. I didn't prep you on this question. I want it off the cuff.
Like I said, this is the zinger, right? That I was waiting for.
So if you could leave this audience with one thing that you felt was most valuable to you, and it could be business, it can be politics, it could be religion, it could be spiritual things, family, whatever it is. I don't care. The mic is yours. What would you think would be most valuable to leave this audience with today?
Wow. Again, a generous question. It's a big question. What comes to mind immediately as you say that, and again, this is off the cuff. Is follow your gut. And it sounds really trite, and it sounds like maybe it's a platitude that I'm stating, but I'll tell you how that means something for me, is that when I don't and things go wrong, I always regret it. I think, gosh, why didn't I just follow? So this is my instinct. This is what I've learned. And another way of saying that, following those neural pathways that are built by making good decisions or making wrong decisions, then quickly righting them. And then even when I don't follow my gut and it goes right, I'm still like, gosh, there's probably another way to sort of look at this. And I'm grateful for, I love consensus. I love working with teams, and I love getting to the right answer. But I'm doing what I do because, and have seen a fair amount of success because of the things that I've learned and my ability to make decisions. And sometimes it's the wrong decision immediately. Maybe it is, but I would rather make the wrong decision fast than the right decision in a slow, methodical, years-long process, because in that year I could have done this, and this. I could have made it that iterative process that it needs to be. Yeah. So listen, I think we all have our own special gifts. You know that you do, and what you've done. You've had a great mentor in your father. John's a great friend and one of those great entrepreneurs that I've ever met in my life. But leveraging those around you is really meaningful. But so choose those mentors wisely, but listen selectively. I have billionaire friends and very, very smart and successful friends and colleagues and mentors of mine, and I've listened to them, and I've gotten some terrible advice throughout the years that if they really knew the context of what I was asking or where I was in my life, they probably would have said something differently. So I don't think it's necessarily their fault, but choose them wisely and then listen selectively as to what might work best for you. And when you do that, then at least when the stuff hits the fan, if something goes wrong, you know it was your decision. Instead of, gosh, I listened to that guy. I didn't follow my heart. I didn't follow that North Star that I know is true. And you live in peace. And I sleep very, very well at night doing that. And when I don't sleep all that well. And I struggle. And sometimes I have to come back and pivot and right the ship a little bit. But it's been a great lesson in my life. And because oftentimes you discount yourself. People will go through, their feelings of inadequacy or feel as though, they're a fraud to a degree. If people only knew, right? But the reality is you know more than you think. And people, if you speak with that confidence, but confidence with humility, people are going to listen. They admire those kinds of leaders and leaders who can own mistakes. frankly. And but don't buy into imposter syndrome. You're starting, if you're starting out fresh, if you're new at what you're doing, you know more than you think you do because you've got the idea. And ideas come and they're a dime a dozen, but your ability to execute is everything. And I think that's really, really important. So I would, I talk to your listeners about just following their heart and their gut and that inner voice because it's meaningful. It's there for a reason. One of the great gifts we all have.
There's a great story in Think and Grow Rich by Napoleon Hill. He talks about this general that for years they had this decision to be made. This new general comes in. They have the 2 pitches coming in. He picks the decision in like 10 minutes. And the other guy is so mad. We've been talking about this for years. You don't understand the context, what's going on. Why would you? Yeah. And he's trying to make this. There was these 2 decisions. And the general said, the cost of not making a decision is much higher than making the wrong decision. And I love what you had like it's such a great ending there. But one thing I wanted to point out was that, and that one thing changed my life. I'm a very indecisive person, someone that'll just sit and just wait. Yeah. And I finally had to say, I got to make decisions and move and follow my gut. Yeah. And the gut, that whatever you want to call it, gut, spirit, God, whatever you want to call it, that North Star will point you in the right direction. I love that. James Clarke, everybody. Thank you so much. Go follow him online. It's amazing to have you today.
Thanks a million, my friend. Thank you.
Okay. Good work.
No, seriously.